vibration that led success so high. I will achieve, I will fly high. In SBI.
I'm backed by the nation's trusted bank, SBI, the banker to every Indian.
Earlier this week, Business Standard reported that PhonePe has asked the National Payments Council of India, or NPCI, to extend the deadline for volume cap on UPI payments. The cap is expected to kick in from January 2023, and as per regulations, PhonePe would have to reduce its share of UPI payments from 48 to 30%. The other big player, Google, will have to do the same. NPCI had given PhonePe and Google Pay 2 years to comply with its norms to curtail market dominance and promote competition. Good morning, my name is Ishan Gera and you're watching the Business Standard Banking Show. In today's episode, we shall discuss the results of the new policy poll. We have an interview lined up with the Executive Vice Chairman and CEO of India's largest cash management and ATM services player, CMS Info Systems, Rajiv Kaul. Our Banking for You section explains the dematerialization of insurance policies, and a banking expert, Tamal Bandyopadhyay, explains why the first half of 2022-23 was so good for bond issuances and why he's not confident about the second half. At the end of our episode, we shall reveal the results of our last poll and ask you the question for the next one. So stay tuned. First, here are the significant developments of the week. Although many had expected smaller rate hikes after the August policy meeting, ECB's 75 basis point rate increase combined with inflation going above 7% in August has raised expectations of a larger rate hike. A Business Standard policy poll found that analysts expect RBI's Monetary Policy Committee to raise the policy repo rate by 35 to 50 basis points on September 30th. The repo rate is currently at 5.4%. A 35 basis point increase would take it to 5.75%. Policy rates are expected to hit 6% by December. Meanwhile, RBI is also trying to infuse stability in the new age lending mediums. A week after releasing guidelines on digital lending, Business Standard reported that the central bank is mulling the possibility of allowing peer-to-peer platforms to foray into secured lending. Transactions and fund movement will be through an escrow account for the broad contours. The current exposure of P2P platforms is close to 4,500 crore rupees, but given that the average ticket size is 22,000 rupees, these platforms cover millions of customers. On the other digital front, the Finance Minister has asked the Financial Stability and Development Council members to provide a clear consensus on the legality of crypto assets. The discussions on crypto either focus on a complete ban or a partial ban. The government shall also need to determine which authority shall act as a regulator if it does allow crypto assets in the country. RBI has been in favor of a complete ban on crypto assets. Public sector banks have also been pushing for digital lending and technology-related reforms. The banks cleared digital lending of 83,091 crore rupees in FY22. As part of the Enhanced Access and Service Excellence 4.0 program, banks focused on digital lending, co-lending with NBFCs and tech resilience. Banks achieved 6,597 crore rupees of co-lending with NBFCs in FY22. A discussion on the digital revolution in banking cannot be complete without referring to the contributions of ATMs. Business Standard's Manojit Saha had a conversation with the Executive Vice Chairman and CEO of country's largest cash management and ATM services player, CMS Info Systems, Rajiv Kaul, on the company's growth plan.
Welcome to the Business Standard Banking Show. CMS Info Systems, which manages cash deployment in ATM among many other things, hit the capital market in December last year. To talk more about the cash economy, the ATM and the CMS growth plan, we today have Rajiv Kaul, Executive Vice Chairman and CEO, CMS Infosystems Limited. Mr. Kaul, welcome to the show.
Thank you, Manojit. Good to be here.
Thank you. There are two main revenue streams of CMS Infosystems. One is the cash management and other is the managed services. Cash management roughly contributes 70% of your revenues. You plan to double your revenue to 2,500 crore by FY25. What will be the driver for this growth?
So we ended FY21 at 1,300 crore revenue, and from there, yes, it's a doubling of the number to roughly 2,600 crores by FY25, which should be a CAGR of 18%. If you look at FY20, which is the year before COVID, we grew 20% in revenue. I'm ignoring the COVID year for obvious reasons. And then you look at FY22, which is the year we just ended, we grew at 22%. So we are on track to meet this goal which you set for ourselves in the midterm. I think at a macro country level, this will be linked to increased formalization of India, which is accelerated post GST, increased consumption in India, domestic consumption in India. From a sectoral perspective, the drivers will be banks expanding their network and reach. Banks also needing to outsource more. In some ways, many banks in India are like the telecom companies 10 years ago, where a lot of work was going out in-house and then they started outsourcing those contracts. And third, I think the regulator in India is very focused on the quality and availability of services to consumers, which is a citizen of India. And they are also insisting on very strong compliance and process norms, which will help grow the sector. At a company level, then, we feel that we are able to see a very strong performance for our core business. And then if you mix it with the fact that we have an order book of almost 2,500 crores today, I think that gives us a very strong confidence of hitting these numbers.
And your market share is cash management services is about 46%. And you plan to increase to 50% by 2024. Do you think you're on track to hit that target?
So if I have to rewind back, right, about 8 years ago or something, our cash management business market share was close to 21%, maybe 22%. That is right now at 46%. We have grown this from 42 to 46 in the last 15 months. I feel confident that we should be able to hit a 50% market share driven by no acquisition. We simply think that the fact that there is a demand for high quality players, high quality of services, deep networks in the country. I mean, everything what we stand for and what we have built over the last 10 years, I think there's an increased need and demand for it. So we feel that setting a goal on organically growing our market share to 50% is quite possible.
There was a lull in the ATM deployment for 3-4 years. It has picked up now. SBI and HDFC Bank are some of the banks which have announced aggressive branch expansion strategy, which will also mean installations of ATM. So do you see more and more banks are installing ATMs going ahead?
Yeah, I think at a sector level, right? At a sector level, the large banks, both public sector as well as private sector, there is a need for them to increase their reach to their consumers. And ATM is only a fulfillment model, right? Finally, a bank, if the bank has to grow, they need capital and they need to raise deposits from consumers and account holders. So they have to increase the number of accounts and they have to raise that. For that, they have to give them access to the banking needs, which comes through the form of a branch or it comes through the form of an ATM. And therefore, you hear about a plan of HDFC, SBI, which you already alluded to, and other large public sector banks, which are looking to expand their networks reasonably aggressively. There was a lull for the last 3-4 years, but that again, I always link this to economy and I link this to sector. The economy was going through a lot of transformation post demonetization, right? Whether it was GST and many other things were going on. Secondly, the banks were dealing with capitalization needs, especially the public sector. So that cycle of infusion of capital and also the PSU bank merger, which delays a lot of investment decisions, took 3 to 4 years time, which looks bad at that time. But from a decadal perspective, I think we have now got a banking infrastructure which is very well poised to help deliver growth for India. We see aggressive plans for banks, not only the two you mentioned, but the banks, to increase their penetration through branches and ATMs. On top of it, the other opportunity of growth which gets neglected is you think of the fact that India has got almost 2.5 lakh ATMs. We are the world's third largest ATM market, which is not recognized very well. Again, linked to the population, we have 2.5 lakh ATMs. These ATMs need to be replaced because technology changes, technology gets obsolete every 6, 7, 8 years. There's a fairly large infrastructure required to be doing that. And we are a very key player in that sector.
The ATM interchange fee was hiked from 15 rupees to 17 rupees for per financial transactions last year, which was after a gap of 9 years. Do you think that the increase has helped managing the cost, or there should have been the increase would have been much more.
Was the increase enough? No, but it'll never be enough for anybody in the sector. I think there will always be a balance which has to be maintained in terms of how that cost can be borne by the population, by banks, and by the sector. Of course, if the interchange was higher, it would have helped enable far more penetration and growth of ATMs. However, I'm relieved that at least the authorities and the regulator and NPCI took a positive view and changed it, because your utility cost goes up every year based on input costs. And it was just wrong in our mind to see that this cost wasn't going up for 7, 8, 9 years, where all costs go up. Your rentals go up, your electricity cost goes up. These are significant costs in running and maintaining an ATM. I still don't think there is a good balance. There should be some automatic process for doing this on linked to CPI or whatever every year, or every 2 or 3 years. Is it enough to tackle the need for ATM growth? No, but I guess, again, we take a very decadal view and saying from a decadal perspective, from a 1 year perspective, not good, but from a decadal perspective, positive step. We hope it remains and maintains and then gets upgraded to the next level whenever the banking system is able to take care of the hike.
Right. On that note, Mr. Kaul, thank you so much for speaking to us. It was a pleasure talking to you.
Manojit, thank you so much for your time. Pleasure was ours, and we'll be in touch. Thank you.
Thank you, sir. Thank you so much.
Kaul says the company wants to double its revenue by FY25. The growth in FY22 has been 22%. He says increased formalization and domestic consumption will drive growth. The insurance industry is also expecting a move towards digitalization. 2 weeks ago, insurance regulator IRDAI said it is mulling a proposal to convert insurance policies to demat form. In a Banking for You section, experts explain the dematerialization of insurance policies.
What is dematerialization of insurance policies? The Insurance Regulatory and Development Authority is contemplating mandating the dematerialization of insurance policies to increase customer convenience. Dematerialization means converting physical documents into a modifiable online object. The insurance regulator started this initiative a few years back, but it did not take off. The customer convenience this move was supposed to provide was outweighed by the operational challenges and costs for insurers. Now the insurance regulator has urged the companies to open e-insurance accounts, EIA, for their customers, which would act as the first step towards the dematerialization of insurance policies. E-insurance accounts serve as a repository of all insurance policies that the customers have subscribed to. At present, there are 4 insurance repositories: NSDL National Insurance Repository, CDSL Insurance Repository Limited, Carvi Insurance Repository Limited, and CAMS Insurance Repository Services Limited. Insurance repositories are companies that maintain insurance policy data in electronic form on behalf of insurers. IRDAI is promoting the dematerialization of insurance policies to create a robust electronic mode of policy solicitation, servicing, and storage. Insurance repositories were set up with the objective of opening an EIA, which would serve as a repository of all customer insurance policies. The dematerialization of insurance policies is essentially like dematerialization of shares. Still, the only difference is that in the dematerialization of shares, customers can do transactions such as buying and selling shares. This feature is, however, not allowed in the dematerialization of insurance policies. It will simply provide a one-stop window for customers to view all their insurance policies, be it life insurance policy, motor insurance, or health insurance policy. When a customer buys an insurance policy, the insurance company will credit that policy to their repository account. The regulator has invited the insurance industry's views on this issue and is expected to take a final call soon.
I am the blue of the limitless sky. I am the inspiration that led success soar high. I will achieve, I will fly high. I am the I in SBI.
I'm backed by the nation's trusted bank, SBI, the banker to every Indian.
The insurance regulator has urged the companies to open e-insurance accounts for their customers, which would act as the first step towards the dematerialization of insurance policies. In 1996, SEBI introduced a demat account for the Indian stock market. Taking off from the market, RBI has done well in bond issuances in the first half. But our consulting editor Tamal Bandyopadhyay believes the second half may not be as good. He also discusses India's attempt for inclusion in the global bond index. Hi Tamal, thanks for coming on the show.
Thank you.
Now, in this week's column, you talk about the bond issuances. Now, the government has done quite well for the first half of the year till now. What is the reason for this?
If you look at historically, this is the biggest ever government borrowing program, what we are seeing this year. And in fact, it started from COVID. And if you combine both center and the state, it's a historic high. But it is a pretty smooth sailing. We are just about a week away from the end of this month and all. It has gone exceedingly well. And most importantly, without any support from the Reserve Bank of India. For the past few years, Reserve Bank of India had been buying bonds through the so-called OMO, open market operations. But this year, so what's happening? There are multiple reasons. One is this, for the past 2 years, increasingly, the share of provident fund and pension funds has been increasing. It's been rising. So it's banks. It's not banks alone that takers. Provident fund and mutual provident fund and pension funds. They had been buying, but they have been buying now more. And second reason, of course, is this the corporate bond market. If you see this year, as we speak, I don't know the latest figure, but at least in the first quarter, it was negative. Yet another factor is that SDL, the state development loans, it's pretty low in the first half. So what happened is this: the government passed on money in advance last year to the states. So that's why their requirement is also much lower.
You are not so confident about the second half. Why do you say the second half would be difficult?
Well, there are multiple reasons. One is this: the SDL, which, as I said, state development loans, not a huge quantum has been raised. States will have to come back. The GST government has not been passing on the way it should have been. Second is, of course, corporate bond market is likely to take off. Bank credit pickup. As we speak, till August end, it's 15.5%, nearly 9-year high. So long, what was happening? Banks are happy. Instead of giving money, chasing credit, they're pretty happy parking their money in the government bond because it's secured. And yes, they were. If there is too much of volatility, there's a M2M losses, mark-to-market losses. They need to take care of that. But overall, they were pretty happy putting in money in government bonds in absence of credit pickup. But now the credit is picking up, and the liquidity also drying up in the system. If you see that, and now we are getting into the festive season, and a few states going for elections. So during that, both for elections and festive season, the currency in circulation go up. Yes, indeed, the government, if you look at the direct tax collection, GST collection, so on and so forth, it's pretty good state. So that may give us hope that, well, fiscal deficit will come down and government would not need to borrow as much as the budget had estimated. But no, if you look at the subsidies, the food, fertilizer, and gas, they would eat into this. So I don't think the government would come back and reduce the size of the borrowing.
You highlight somewhere in your column that the share of foreign investors in bonds has been declining. But the talk of the town right now is India's inclusion in the global bond index. Is it the panacea for all of India's problems?
Yeah, Ishan, it's a very right question. Everybody is discussing that. And every now and then it comes up, In fact, I remember 2014 when India had the record current account deficit. There were discussions between JP Morgan and Reserve Bank of India. for inclusion in the bond index, but that did not happen. Now, historically, if you see, foreign money flow in the debt market is roughly about 1/3 of what's the foreign money flow in the equity market. We opened up the equity market immediately after economic liberalization in 91, but we opened up the debt market for foreign investors in 95. And trust you me, the first flow happened in 1997. That was just a measly 29 crores. Okay, so that's the kind of thing. Foreign investors, we have never been able to attract foreign investments to debt. Now we are trying to. There have been discussions. Yet again, it's in the news. But India is not a free market for foreign investors because there are a lot of restrictions. How much you can invest in which paper, maturity, etc., etc. So you need to free up. You need to free this up. So that's a very critical part. I mean, like equity market, there's no restriction. They can put in any equity. Similarly, you have to do that. Right now, both for state development bonds as well as central bond, there are a lot of restrictions where they can put in money, how many years they can stay invested, so on and so forth. So discussions are on. You need to free up the market, and then we'll see the flow. Now, there are pros and cons why the government and Reserve Bank of India, I would like to believe, is not too excited about it because they have been discussing the pros and cons. Now, what happened is this: once you become integrated with the global market, so there will be inflow, and once there is inflow, then your rupee will appreciate. But at the same time, for any geopolitical development, whether it is China, Taiwan, or whether it's Russia, Ukraine war, anything, there will be outflow. In that case, there will be rupee will be sharp depreciation. And of course, there will be impact on bond yield. So on the positive side, it will ease the burden on the banks because they are the primary buyers of the government bonds, apart from mutual funds, a bit, and retailization has never happened. Even though we are trying to push it hard, but I would like to believe it's not even 1% retail participation. So it's banks, provident fund, and insurance. They are the primary buyers. And then you have mutual funds and a few others. So it will ease the burden on the banks. But on the other side, as I said, inflation targeter, a flexible inflation targeter, Reserve Bank of India, would need to go back to its multitasking also, managing the rupee. So it's not if you ask me, it's not a panacea.
Thanks, Tamal. Thanks for coming on the show again. We hope to see you next week. Thank you.
Thank you.
Tamal says the global bond index inclusion cannot be a panacea for all problems. Moreover, if India goes ahead with the plan, RBI would have to play a more active role in currency management. Given the recent activity on the digital front, we asked you a question last week, whether the RBI should liberalize rules on fintech innovations. 69% of the people did say RBI should move towards the path of further liberalization. As RBI's Monetary Policy Committee meeting is approaching, we would like to know how much you expect RBI to raise rates in the September meeting, since ECB has raised rates by 75 basis points and Fed is expected to follow suit. 25 basis points, 30 basis points, or 50 basis points are the options. You can respond on Twitter, Instagram, Telegram, LinkedIn, and our website. Our polls open on Friday, so make sure to respond. We'll be back next week with more news and analysis. Thank you for watching.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.